Hi, everybody. Thanks for joining us and logging in. We're going to give everyone a few seconds to just get logged in here. Hope everyone is having a wonderful day. Oh, a few more logging in. Okay, I think we'll probably get started here in a few more seconds. Okay. Hi, everybody. Thank you so much for joining us. I wanted to go over a few items today and just kind of some housekeeping items so that we can just go through everything here. And wanted to let you know that we have some exciting information to talk about today. In addition, some good giveaways to give you. So again, if you could give us any of your feedback, the good, the bad, the ugly, constructive criticism is how we get better. I'd greatly appreciate it. And we'll go from there. So today we're going to talk about the tax time bomb and how you can avoid it. So I want to educate you today about what that looks like from a retirement planning perspective and just give you an insider's look about how we can make sure that we're not paying more taxes than we need to in retirement. In addition, so that we can make sure that we are able to spend as much of our income as we want to. At the end of the webinar today, we're going to be offering a free complimentary 15-minute phone call with one of our team members to see if there's something that we may be able to do to help you prevent the tax time bomb from occurring in your portfolio. And in the middle of our webinar here, I'm actually going to be giving you two pieces of information. They're just PDFs that you'll be able to download right out of the webinar today with lots of information about how to avoid the tax time bomb. So we're going to talk all about that. And as we go through this information, we're just going to go through it. And if you have any questions, please put them in the chat box. I'm not going to be answering questions live today because I don't want to keep us here for a really long time. But if you do have questions, put them in the chat box and we'll make sure that we get back to you with the email that you provided when you registered. So hope everyone is doing well. And if you need a different email, just let us know that as well after today. So again, thank you everyone for tuning in. So we want to talk about the tax time bomb. The tax time bomb is really about how you save your money. So how you save your money matters, and it matters now for tax deductions and things like that. But it really matters the most for our retirement income plan because there's a lot of unknowns that we need to plan for, and I will walk you through what those look like and how we can make sure that we're planning the best that we possibly can with the known variables that we know today. So here is a little a bit of our topics for today. I'm going to talk about IRAs versus Roth IRAs and the difference on how they're taxed. I'm going to talk about tax preparation versus tax planning and the difference between the two. And then we're going to dive into the tax time bomb and what the tax time bomb can do to your retirement income plan and how we can avoid it with some different tips and tricks. So first of all, your traditional IRA, some of you may already know this information, but I'm just going to throw it out there because we may have some people on joining us on the webinar that don't know. So on a traditional IRA, when you contribute money, whether this is a traditional 401k or your 403b or a TSP if you have one, when you contribute money to the traditional side of these accounts, you actually get a tax deduction today. So if you put in $5,000, you get to write off $5,000 from your taxable income. It can be a really great tool. And the 401k in and of itself is a wonderful conduit to be able to save money directly out of your paycheck and not really see it or feel it come out. And so that can be a wonderful solution. For a lot of us that are in the retirement planning world, a lot of times we see a lot of clients with a lot of money in traditional IRAs and traditional 401ks, okay? And it's not your fault. You didn't do anything wrong. Traditional IRAs were around before Roth IRAs. And so in addition, a lot of 401k plans still don't even offer a Roth option. The TSP just added it, I think it was a few years ago. But here's the plan, is that we're going to talk about why it makes sense to be utilizing the Roth option if we can. And if we can't, we have a solution to make sure that we are partaking in the best way of saving moving forward. So in a traditional, you get a tax deduction today, but all of that money grows, and it all grows tax-free or tax deferred, which is wonderful. But at some point, it's not tax-free, because at some point in the future, when you or your beneficiaries withdraw that money, it's all taxable as ordinary income. So we hope that when we invest our money, that it's going to grow. And over time, we hope that that growth continues and continues and continues. And we hope that the amount of money that we have invested grows to a lot larger number. And so in a traditional IRA, when you take the money out in retirement, it's all taxable. And so we got a tax deduction on a very small amount, and then it grew, and then we have to pay taxes on all of it. We have a little joke in our office called saying that the IRA is the IRS's retirement account. Little joke, kind of funny, but not really. And so we'll talk about some of the pros and cons of traditional IRA investing. Secondly, the Roth IRA. So the Roth is the idea that you put money in today, you do not get a tax deduction. So that's the downside. You don't get a tax deduction. So the money that's going into that account is actually technically after tax. And so you put that money in to the Roth, there's no tax deduction, but it all grows tax deferred, just like the traditional IRA. And in retirement, when you take that money out of the Roth, it's 100% tax-free. You already paid taxes on the money that went in, and it grew all tax deferred, and all of the money that comes out is now tax-free. So it's important that you understand the difference. So we're going to talk a little bit about tax preparation versus tax planning now. Everyone has, if you've ever talked to a CPA, when do you guys talk to them? Put it in the chat box for me. Do you talk to them at the beginning of the year, the middle of the year, the end of the year? Someone typed in, April 14th. Yeah. So, right. So a lot of times we're talking to our CPAs right before tax preparation time. And CPAs are wonderful. We need them. They're great. They prepare our taxes for us. But a lot of CPAs are not tax planners. And so a lot of times when you go and speak to your CPA, the only advice that they can give you is, oh yeah, go make a traditional IRA contribution, put in $5,000, $5,500, $6,000, $6,500, whatever it is, based on your age and how much you're able to save. But that's the only real way that they can tell you to save taxes. And that's because it's past the December 31st time frame, typically, when you're speaking to your CPA. And so they can talk to you about making those traditional IRA contributions to save you money on your tax return, which is great. However, what's the long-term ramification of that contribution? And so we're going to talk about that. And does it make sense to make that traditional IRA contribution, or should we be putting it into a Roth? And so we'll talk about that. And then we're also going to talk a little bit about Roth conversions as well. And does it make sense for you? What does that look like? So I'm going to give you the first file I want to share with you, which is the tax time bomb numbers. And so if you pull that up, you'll be able to see kind of what I'm talking about here. So go ahead and pull that up as we're going through this. And just glance at it, and you can see on the document that over time, this person on the left-hand side got great deductions for the contributions that they made to the traditional IRA. And then on the right-hand side, you can see, based on the updated required minimum distribution age at 72, you can see that the withdrawals start coming out at your required minimum distribution age when the IRS mandates that you take money out of your IRAs. And now there's taxes paid on that money. So you can see with those growth rates and everything, how much on the left-hand side we saved paying taxes on, but on the right-hand side, we paid a lot more in taxes on a lot more income over time. And this is how we can end up with a little bit of a tax time bomb. And so this is a person that contributed to a traditional IRA throughout their working years and saving years. And then in retirement, they withdrew that money and then passed it on to their beneficiaries as well. When you pass your IRA on to your beneficiaries, it's all taxable to them at their ordinary income rates. And so understanding that is very important. So again, it's not your fault. You didn't do anything wrong, but how do we fix it? There are solutions. And so we'll talk about that. So the Roth IRA, again, is a way that we can save. It can all grow tax deferred. When we take it out in retirement, it'll all be tax free. So what makes sense for you and why? Well, one question I have, and you guys can just ponder on this, think about it, is the age-old thinking was, well, I'm going to be in a lower tax bracket when I retire. And so therefore, I should be contributing to a traditional IRA because when I retire, I'm going to be in a lower tax bracket, pulling in less dollars than I am today. And therefore, I can make these traditional IRA contributions knowing that I'll be in a lower tax bracket in the future. Well, if you look at actually historical tax rates in our country, they're lower today than they've really been in a really, really, really long time. If you go back to the 60s and 70s, the top marginal tax rate in our country was above 90%, 90. And so one thing that no one in the media is talking about anymore is the amount of debt that we're in. And where is that money going to come from to pay off that debt? I'm not quite sure. I don't have a crystal ball. We always joke with our clients that we have this crystal ball to predict the future, but it's broken. It doesn't work, right? So, where are tax rates going to go in the future? Who knows? What we do know is our tax rates today, and what we can plan for is our tax rates today. And so one of the biggest variables that we need to plan for as retirement income planners is what are tax rates going to be 20, 30 years from now, 10, 15 years, wherever you're at from retirement, 40 years if you're in your 20s, right? Where are you at as far as what tax brackets are going to be? So yeah, you might be pulling in less dollars. The total amount might drop in dollar amount. However, if you're paying, 20% more in taxes on a lower dollar amount, do you still get to spend as much? And so that's a huge variable that we have to try to mitigate that risk in our retirement income planning. And so one of the ways that we can mitigate that risk is by doing a Roth conversion. So Roth conversion is simply taking money that you already have in your IRA and moving it over to a Roth IRA. And you can pay the taxes on this two ways. Two ways you can pay taxes. So you can, if you have, $100,000 that you want to convert in 1 year from a traditional IRA over to Roth, you can move that $100,000 over to the Roth and just pay the taxes out of your bank account, another savings account that you have when you go to file your return. Or the second way is instead of $100,000 going from IRA to Roth, you can withhold money from the conversion. So $100,000 over here, maybe it's only $75,000 that then goes into the Roth because you wanted to send 25% out of the account to pay a tax bill. Okay. Ideally, in a perfect world, we do option one, where we have more money in the Roth. It's all going to grow tax free. But if we can't do that and we need to either do all of it in option two way, where we withhold the money from the conversion, you can do it that way. Or you can do a mix of the two. Maybe you need to pay 25% taxes, but you only withhold 10% when you convert it over. So now you have $90,000 in the Roth and you have a smaller tax bill at the end of the year. So there's all kinds of different solutions to get that money from a purely taxable state to a tax-free state. This can make sense for someone who's already in retirement. This can make sense for somebody who's going to retire next year. It just depends on your total income plan. And the next thing I want to give you is why it can make sense if you're near retirement or within a few years of actually already retiring. And the reason why is a calculation called the provisional income calculation. Provisional income. I want you to write that down. Get out a pen, type it on your computer, do whatever. Provisional income calculation. Okay. So the next file I'm going to give you is really important. And if either of these ideas are things that you haven't thought about, or if you are working with a financial professional that you haven't talked to them about, it's a great reason for you guys to take advantage of the complimentary 15-minute phone call that I'm going to be offering you here in just a minute or two. Okay, there's the provisional income calculation. You should have that. That's just an AARP article. We had nothing to do with it. And it's got all kinds of information in there about provisional income. Here's the deal. If you create your retirement income plan in the right way, meaning that the income is coming from the right sources, and when you retire, then you can be in a spot where you're paying the least amount for your Medicare premium and none of your Social Security gets taxed. Let me repeat that, okay? If you create your retirement income plan in the right way, you can be in a spot where you pay the least amount for your Medicare premium that you have to, and you can be in a spot where none of your Social Security benefit gets taxed. Read over the provisional income calculation, or if it's too much information, just take advantage of setting up a time with one of our team members at our firm. And we'd love to help you and help you design that income plan if you need it, or just guide you in the right direction to be able to do it yourself. But it's really important that you take care of these things, because what we don't want is to be in a position where we're paying taxes on up to 85% of our Social Security benefit. And instead of paying, under $200 a month for Medicare, we're paying almost, $600 a month for Medicare a month per person. So it's really important that you understand these things, that they get worked out in your retirement income plan. And if you don't have a financial professional and you're trying to guide yourself along this path by yourself, I urge you to hire a financial professional. Find somebody whom you trust to guide you through this path, because pensions are mostly gone today, and the monkey's on our back to make sure our retirement income lasts. And so take advantage of the 15-minute phone call. Look forward to hearing from all of you. Hope everyone's having a wonderful day, and feel free to share this with your friends if you found it valuable. Thank you, everybody. Here is the 15-minute phone call. There you go. So you guys should see that come across on the webinar. And like I said, feel free to pass this along. Go ahead and find time on our calendar to chat with somebody. Provisional income can help you lower the amount of Social Security income that gets taxed, as well as lower the amount of your Medicare premium. Understanding Roth IRA versus regular. Should you do a conversion, how much and when, and just kind of understanding all of those different pieces. So I appreciate you all tuning in today. I look forward to chatting with you, and our team looks forward to hearing from you as well. Thank you, everyone. Have a great day.